Moving averages are some of the oldest and most trusted indicators in trading. Traders often layer multiple moving averages to spot famous signals like the death cross. But what if you didn't need a cluttered chart full of lines? What if there was a single oscillator that combined all that data into one simple tool, clearly showing you the trend and potential reversals? Well, that's exactly what this indicator does. And today, we're giving it to you for free and showing you exactly how it works. Let's jump in. A moving average smooths out price data and helps identify trends by calculating the average price over a set period. Traders often buy above or sell below this average, or they combine multiple averages to spot crossovers for entries. There are countless variations: simple, exponential, weighted, and more. But here's the problem. Most traders don't know which moving averages to use or when to use them. The result? A messy chart filled with lines that leads to one thing: analysis paralysis. This indicator avoids this issue. When you add this indicator to your chart, you'll see green and red columns along with a blue line. The columns measure how many simple moving averages sit below the current price on each bar. When the reading is above the midpoint, teal columns appear, showing that price is trading above more than half of the moving averages, a bullish condition. When the reading falls below the midpoint, red columns appear, signaling that price is only above a minority of the moving averages, which is bearish. The blue line is the proximity index, which tells you how closely price is hugging its moving averages. A low value means price is clustered near the faster, shorter-term averages, which often happens during strong momentum moves. A high value means price has drifted back toward the slower, longer-term averages, typically during consolidations or pullbacks. In an uptrend, a low proximity index confirms bullish strength, while in a downtrend, it confirms bearish pressure. Inside the settings, you'll find several key options. The minimum and maximum length inputs define the range of moving averages used in the calculation. For example, a maximum length of 100 means the slowest average will be a 100-period MA. The smooth input helps filter out noise, with higher values creating a smoother, more stable reading, though at the cost of slower reaction to price changes. Lastly, the normalize option, which is enabled by default, scales the output from 0 to 100 so the columns can be interpreted as percentages. Now that you understand how this indicator works, let's look at how to actually apply it in your trading. Where this indicator truly shines is in helping you time your entries, especially when a market is trending or transitioning from a range. In this example, we see a shift from a bearish to a bullish market, indicated by the column color changing from red to teal after crossing the midpoint. But that alone isn't enough to justify a trade. We need additional confluence. First, we want to see the proximity line sloping downwards and dropping below the midpoint. This suggests the market is gaining momentum and that price is hugging the faster moving averages. Second, we need to confirm that the teal columns are still making higher highs. If they begin to flatline or decline, that's a warning sign. Once both conditions are met and a bullish candle forms, that's our entry trigger. At that point, we can take a trade with stops placed just below the candle and aim for a 1-to-2 risk-to-reward ratio. Now notice, just a few bars later, the columns begin to flatten. While that doesn't necessarily mean the market won't move higher, it does suggest we're entering a less ideal zone for new trades. The goal is to position yourself while momentum is building, not once it starts to stall. Now, if the market isn't just transitioning but is already in a well-established trend, and you're looking to enter during a retracement, here's how to approach it. In this example, we're clearly in a strong bearish trend, as shown by a long stretch of red columns indicating sustained downside momentum. The key here isn't to chase the move, but to time your entry on a pullback that aligns with the trend. You'll want to avoid entering while the columns are flat. Instead, wait for a retracement and watch closely. Ideally, both the columns and the proximity line should pull back without rising above the 20% level. This range is considered optimal for a continuation entry during a downtrend. At this point, we still need one final confirmation to trigger the trade. That's where the signals and overlays confirmation signals algo comes in. Once we receive a bearish confirmation signal marked by red candles, and both the columns and proximity line remain below the 20% level, we can confidently execute the trade. Place stops just above the recent swing high and aim for a 1-to-2 risk-to-reward target. To apply this setup in an uptrend, simply flip the logic. You want a strong bullish bias indicated by teal columns, and during a pullback, the proximity line should stay below 20% while the columns remain above the 80% level. That's your window for identifying continuation entries with the trend. And that's just one of the many ways you can use the Moving Average Proximity Oscillator, a smarter way to visualize trend strength, momentum shifts, and entry timing using layered moving average logic instead of cluttering your chart with endless lines. You can get access at LuxAlgo.com/library. For best results, pair it with the Signals and Overlays toolkit. With confirmation signals, smart trail, and real-time reversal zones, you'll be able to manage trades with precision and filter out low-quality setups with ease. Try it for 30 days risk-free at LuxAlgo.com. Don't forget to follow us on X for daily setups, strategy breakdowns, and exclusive updates. Thanks for watching.